Good morning, and you're all very welcome to our Small Firms Association webinar this morning. My name is Sven, and I'll be facilitating our session on the Irish economy and what the future holds in store. We're joined this morning by Dr Loretta O'Sullivan, who's Bank of Ireland's Group Chief Economist and Head of the Economic Research Unit. And we've also with us Pierce Butler, who's Head of Sectors in Bank of Ireland Business Banking. Before I ask Loretta to give us an overview of what the Irish economy holds in store for us, just a few housekeeping items. Please raise your digital hand if you have any technical issues with the webinar, and we'll get in touch with you individually. Also, if you have any questions during the webinar, please email them to us at info@sfa.ie. Now to you, Loretta. How do you see the Irish economy performing presently, and how will we all be affected by Brexit and possibly looming trade wars?
So good morning, everybody, and thank you, Sven, for the introduction. Yes, lots of things going on in the Irish economy at the moment, some internal factors, some external factors that are going to play out over the next while. So what I wanted to do was run through some of the recent developments and take a look then at some of the challenges that lie ahead. So I might begin by showing you some graphs that you'll already be familiar with. These are the headline indicators for the Irish economy, GDP and GNP. And what you can see there is that there has been a very significant improvement in the economy in recent years. So graphs heading upwards at new peaks in terms of GDP and GNP, though we do know, of course, that some of these measures are impacted by globalization effects, so they can slightly overstate what's happening in the economy. GDP in the first half of the year was up 9%, GNP also in double-digit territory. So that's a very strong performance. What I will show you when we take a look at some of the other indicators is that this is reflected throughout the economy. If we look at what's happening in terms of the consumer, if we look at some of the things that are happening in terms of the labour market, we see an economy that is doing well. So let's kickstart that off and first of all take a look at sentiment and how that has been playing out. I want to share with you this morning some of the insights from an economic sentiment tracker that we do at Bank of Ireland, where on a monthly basis we survey 1,000 households and we survey over 2,000 firms. And we bring this information together, we collate it into what we call our economic pulse here, which is tracking sentiment amongst households and firms over the last number of years. It is timely. We began this back in 2016, and since then we've obviously had the referendum on Brexit. We've also had the election of Donald Trump in the US. If you take a look at the graph, you'll see there was a dip on the back of both of those outcomes, some recovery, and since the beginning of this year, like that GDP, GNP data that I was talking about, which has grown strongly, we also saw very strong sentiment as well. So a good performance in terms of sentiment in the first half of the year. You'll notice that over the summer months, though, it has taken a little bit of a dip, and that is coming on the back of some of the renewed uncertainty around the Brexit process in particular, where we've had we've been in a bit of a deadlock situation around the talks. There hasn't been an awful lot of progress, and indeed there was increased speculation about the possibility of a no-deal Brexit. So sentiment taking a little bit of a hit there in more recent months, but it does come after a strong performance in the first half of the year. So those two factors, that strong performance in the first half of the year and some of those clouds that are on the horizon around Brexit for the second half of the year, are informing our forecast at Bank of Ireland for the Irish economy. And this year we're looking at GDP growth of 6.5%, which is a good performance again. Puts us at the top end of the euro area league table. And next year, assuming that we get some sort of a transition agreement in terms of the UK-EU relationship, we're looking at growth of 4.2%. So that's the headline picture. Let's step a bit back from that and delve underneath, and we might take a look at what's going on with the consumer and what's going on with the business environment. So On the consumer side of things, this is a catch-all graph. So it's showing consumer spending, what's happened since 2007 up to 2018, our latest data point. And again, you see a similar trend to what we saw in terms of GDP and GNP. It's on an upward trajectory. Consumer spending at a new peak. So this is telling us that consumers are back spending. This has come after a period where obviously they were going through, or households were going through a retrenchment, a rebalancing, and it's now coming through strongly that they're back in the market, back spending again, growth of about 3.5% in the first half of the year. Supporting that spending is an improvement in consumer confidence. This is the bank's Consumer Pulse data, which is the survey that we do amongst households each month, collating their responses across a whole range of questions. And you can see that that's been on a broadly upward trajectory there since around 2017. Little bit up and down as we go along, but the broad trend has been quite positive, and it is at a high level. And to give you a little bit of insight as to what's behind that, one of the key questions that we ask households is around how they view the general economic situation. Do they think things are going to get better? Are they going to stay the same? Are they going to get worse? And what we find is that 1 in 2 think things are going to get better. So they're positive in terms of their outlook for the economy. In terms of their own financial situation, they're also quite positive. So 1 in 3 thinking their own finances are going to improve. This data is from September. We'll be getting our October data shortly, and that, of course, will take account of the budget. So we'll see if there's any improvement there, and households are a little bit more positive, perhaps, about their own financial outlook. So, as well as being quite confident, households and consumer spending are also benefiting from the fact that the labour market is doing well. Jobs are being created, the unemployment rate is falling. The graph that's up on the screen now shows you what's happened in terms of jobs over the last number of years, again going back to 2007 and up to the most recent data. And you can see that this graph too is at a new peak. So the jobs that were lost during the crisis have now been regained. It has taken quite a period of time to regain them, but we are now back at that previous point. And the jobs that are being created now, it is broad-based job creation. We're seeing them across the country. We're also seeing jobs being created throughout all the different sectors of the economy, which is important in terms of the recovery being sustainable and being broad-based. With those jobs being created, the unemployment rate has come down. And for many of us, when we're talking about the economy, and you yourselves will know on the ground, that this tends to be quite a good measure of what's happening and gives us a feel for what's going on. That unemployment rate has come down from about a peak of about 16% down now to 5.4%. So we're very much heading towards the full employment mark. We typically, broad rule of thumb, would put that around the 5% mark. So we're not too far off it. And, you know, as you know yourselves from a business perspective, as we're starting to use up that spare capacity and those resources in the economy, it's becoming a little bit tighter in terms of the labour market, a little bit more difficult in terms of attracting staff, retaining staff, and so on. From the workers' perspective, with that unemployment rate coming down, the labour market tightening a little bit, we're starting to see some uptick in earnings. So wages have been improving. First half of the year growing on average by around the 3% mark. And our survey data from Pulse would suggest that it's almost 2 in 5 firms are looking at giving a pay increase, a basic pay increase in the coming 12 months, which coincides well with workers, because 2 in 5 of workers are looking for a pay increase. So everyone appears to be on the same page in that respect. With earnings growing, but inflation being fairly subdued, it means that households are getting a little bit more bang for their buck, and that's also providing support. And when I think about the economy and when I think about the consumer side of things in particular, Another very significant development and what has changed in recent years has been the picture around debt. Households obviously were very leveraged in the run up to the crisis. A huge amount of debt had been built up. In the subsequent years, we saw a repayment of that as people worked through their balance sheets, paid it down, and so on. We went through this period of deleveraging. That situation now has significantly improved. So where we had a household debt to disposable income ratio of around 210% at peak, we're now down to 133%. So with less debt and the repayment of that piece, that has provided support for spending as well. And also, we've now moved into a situation where there's more new borrowing taking place than there is repayment, meaning the credit picture has turned positive as well. So for consumers on the whole, they are in a reasonably good space. We have a labour market that's providing support. We have a debt picture that's much improved, an inflation environment that's quite low. So all in all, in reasonably good shape for consumers. It's not to say that everything is perfect. Obviously not. That could never be the case. And there are some concerns. And when we talk to the households on a monthly basis, they do point to a range of things as factors that they are worried about. So everything from paying their household bills, unsurprisingly, the cost of renting, rising house prices, given what we know is going on in the housing market, the tax burden. So again, one that would have been relevant for the minister there in the budget. People also still a little bit concerned about their incomes as well. So broad picture, quite positive. A few niggly things that are still weighing on minds. So we'll switch tack and we'll turn over to businesses and take a look at some of the indicators in the business world. So first up, if we have a look at investment, and this is the picture, this is the data from the CSO, which again goes back to 2007 up to our most recent data. We've two lines there. The first one is investment. And the second one is modified investment, where we've subtracted some of those globalization effects. So things like the volatile intellectual property related imports, aircraft leasing. When we strip those out, what you're seeing is an uptick in investment, but it's less volatile than the series above it, which obviously had this big jump for a period of time there, reflecting some of those globalization effects. So underlying that investment picture, what's going on? We have strong demand, which is supporting house building. We have a rebound in business investment in the first half of this year. So machinery and equipment core investment improving. And we can see that also then in our sentiment data, our business pulse data, which is surveying the 2,000 firms or so on a monthly basis. You will see there and that over the course of 2018, there was a rebound, so an uptick in sentiment amongst firms. A lot of this coming on the back of the fact that the domestic economy has been doing very well, that our trading partners are growing, and those factors providing support. It has softened a little bit sentiment, though, again over the summer months, and this is reflecting that Brexit story and just the uncertainty that started to come to the fore again. And we'll talk a little bit to that in a minute. To give you a sense of what's behind this business pulse number, so if I break it down, we ask a couple of different questions, and for any of you who get phoned by our survey company and answer all these questions, very much appreciated. Thank you. One of the questions that we do ask is around business activity over the next 3 months. And this graph is showing you the responses for firms across the 4 different sectors that we survey. So we talk to firms in industry, services, retail, and construction. The bars in red there, so all the ones above the line, all those firms are saying that over the next 3 months, they think that things are going to improve for their business. So it's around 1 in 2 firms. And you can see it far outweighs the number of firms who think that things are going to disimprove. So the balance of expectations is in positive territory. The same applies when it comes to hiring intentions. All the guys in red here, they intend to hire over the next 3 months. There you can see industry is quite strong, so is construction, and we know that there's obvious shortages of workers in the construction sector. But services and retail also hiring there, and the hiring numbers being above the firing numbers. So again, the balance in positive territory. So they suggest that firms are also in reasonably good shape in terms of how they see things. 3 months is quite a short frame, a time frame. So we do on a quarterly basis ask about ambitions over the next 1 to 3 years. So a more medium term perspective. Where do firms see themselves going? Do they see themselves staying the same size? Are they going to scale down? Are they going to grow? What comes through in the data, it's about 3 and 5 firms that are on a growth trajectory. The guys in red at the bottom there, these are gung-ho, so aggressive, looking for new opportunities and willing to pursue them. The guys in peach, these are also looking to grow, but are a little bit more cautious. And of course, that is very understandable given the crisis and the experience that many firms have had over the last number of years. So there are still some scarring effects there. But I think it is a positive that in the round, we're talking about 3 out of every 5 businesses having ambitions to grow over the next number of years. And in terms of supporting investment and supporting those growth ambitions, it is also encouraging to see that the credit picture, the lending to NFCs, the stock of lending to NFCs, has also moved into positive territory. For many businesses, the domestic market is important, and exporting is obviously also important in the context of the Irish economy. So this next graph is just giving you sight of what the export picture looks like over the last number of years. Again, it's a broad picture of a strong increasing trend. We have a little bit of a jump there where we have some globalization effects as well. But looking through that, we see a fairly strong growth in terms of exports, and they're now at a high level. Behind that, what's driving it? Firms are benefiting from the fact that Ireland's main trading partners are growing. So we export to the US, and that's growing very strongly. Another key trading partner for us is the euro area. There too, we're seeing solid growth around the 2% mark or so. And the UK, which of course is key for some of the indigenous industries in particular, that's also growing, albeit it's a little bit more moderately so at around the 1.5% mark. So those factors are providing support. A little bit more of a headwind has been the currency, and particularly the developments in respect of the pound, where obviously Brexit has been a big factor here, and we've seen the pound ebb and flow on the back of some of the announcements that have come through over the last number of years. The pound currently around the 88p mark, so that is something that obviously starts becoming a pinch point for firms and something that we are watching closely. So we talked a little bit there about the consumer. We talked about the broad business picture. I want to touch, just before I finish up, on a couple of items that are on the agenda for Ireland at the moment, and also from a business perspective. Key one is clearly Brexit. In addition, we have trade tensions. The international tax environment is an ongoing and long-running development that we'll be keeping a close eye on. Infrastructure has come to the fore, particularly as the economy has started to recover and we started to use up those spare capacities. That spare capacity, we're starting to see some constraints and some hitting against barriers in respect of infrastructure. And again, we had the discussion, and obviously there's been a lot of focus on the budget over the last week or so, and the public finances and where the country is in terms of its debt position. So let's take 2 of those and run through them. We might go with Brexit and go with infrastructure. Brexit for Ireland, obviously there has been a huge amount of focus here, not unsurprisingly. We have very close ties with the UK in terms of our trade relationship, but also wider ties in terms of cultural, political, social, and so on. And we know that some sectors of the economy are more vulnerable than others. Overall, we are less exposed to the UK than we were in the past, but there is definitely a concentration and a vulnerability for some sectors, agriculture in particular. Um, in terms of the nature of the relationship that's agreed between the UK and the EU, this is really going to be key when we think about what impact Brexit is going to have on the economy. A whole series of analysis has been done around this, and it is the case, and the analysis would suggest that whether it is a hard Brexit or whether it is a soft Brexit, it will have a negative impact on the Irish economy. We will be worse off than in the absence of Brexit if the UK stayed in. And those effects are really coming through on the export side. So it is a negative for exports, though we may see some positives in terms of FDI. Obviously, the softer the Brexit, the better in terms of it being less damaging. There's a way to go on this yet. Obviously, the negotiations have started to move on again, and this is they are pretty much at a critical juncture now, and there's going to be discussions, and how things will play out over the next couple of weeks will be very important. In terms of the economy and what effects we've seen of Brexit so far, we mentioned the currency there earlier, and that's has been key. Also, Brexit has been playing out in terms of sentiment, and we saw that coming through in some of the business sentiment data. One question that we ask in our survey, which I think just illustrates that point about Brexit weighing a little bit on firms' sentiment and dampening the mood, is a question we ask about what it means for investment decisions. And typically, when you have an uncertain environment, firms quite naturally will sit back and will decide that they will adopt a wait and see approach. So they tend to put their investment plans on hold. And that's what we saw coming through in response to a question we ask about Brexit and what impact it is having on firms' investment decisions. In March 2017, when we asked this question, you'll see there that around half of firms said that they had put their plans on hold. This was at the time that Article 50 got triggered, so it was obviously very significant. A year later, we asked the same question, and you can see that the number of firms that have put their plans on hold, it moved down a little bit to about 44%, so a little bit lower, albeit still fairly high. And this came on the back then of some agreement around phase one, some agreement around a transition approach, and so on. So it is something that is very much impacting on firms, and that is very relevant for firms. So it will be interesting. We ask it again, this question, in November, to see how what impact the progress or lack of in terms of the talks has come November. I mentioned there that some sectors of the economy are much more vulnerable than others, and that clearly comes through in the surveys when we talk to the farming community in particular. Vast bulk there see Brexit as being negative for their businesses. And also, this is quite broad based in terms of being across the country. So firms in Connacht, Ulster, a little bit more concerned than elsewhere, but at the same time, you can see from the data across the regions that Brexit is something that firms broadly are very worried about. Not unsurprisingly, been worried about it. We talked a little bit about currency, but there are a whole range of factors that Brexit is going to potentially have implications for, everything from contracts to supply chains to taxation, technology, market operating structure, and workforce. So all of these are relevant things, and things that are going to come to the fore and will have to be teased out as we work our way through this situation. Before I finish up, I just want to share with you some results around the infrastructure issues. So this is something that has been coming increasingly to the fore over the last while. So in our September round of surveys, we talked to firms about their regional business environment and around the different aspects of infrastructure and how they were impacting on them. What we found was that firms in Munster, in the rest of Leinster and in Dublin all called out housing as being the priority area for investment in their local economy. So they saw this as key because of the need to attract and to retain staff. In addition, transport featured quite strongly in the likes of Munster and Connacht Ulster. Telecommunications scored very poorly in Connacht Ulster, and generally it scored less well once you went outside of Dublin, whereas there was a broader level of satisfaction with basic infrastructure like water, waste, energy, and so on. So this area, obviously, with the new National Development Plan, has been a key focus of government and a key focus of the budget. So we should be looking forward to seeing some improvements in this respect over the next while. Okay, I'm going to sum up and bring all that together. To put it into a couple of words, our view would be that the Irish economy is sailing on. We are looking at strong growth this year, around 6.5% in GDP terms, around 4.2% next year. That is on a GDP basis, but if you look at the indicators and look at the picture behind that, the factors around the consumer spending, what's happening with the labour market, unemployment falling, the business picture with firms being quite confident and ambitious about growing, you see that there are a number of reasons for that positive view and positive outlook around the economy, but it is fair to say that there are choppy waters ahead. We talked quite a bit there to Brexit, which is the key one, and there are a couple of other areas that we'll be keeping an eye on as well. So thank you very much for your attention, and I'll stop there.
Thank you very much, Loretta, for this really comprehensive overview and outlook of the Irish economy. I would now like to bring in Piers Butler. Piers, you're the head of sectors of Bank of Ireland, and you are in touch with businesses, small businesses on a daily basis. How confident do you think businesses are on the outlook of their performance in the context of the overall economy?
Sven, thanks, Sven. As Loretta had mentioned there, coming through from the economic pulse is that 1 in 2 firms are positive about their outlook for their own business, and we've seen a strong increase in sentiment in the first half of the year with a drop in recent months. I suppose how we've seen that in terms of from a customer perspective is, look, they're positive around the outlook for their own company and for the economy overall. And really that has led to an increasing number of firms looking at investment in their business as their own company's performance improves.
And tell me, Piers, investing in their businesses for growth, how are small businesses or businesses in general funding their growth and funding their investment?
Maybe just to give a sense firstly of what sort of investments we're seeing, I suppose it varies across different sectors. In relation to the hospitality and retail area, we're seeing a number of customers renovate and refurbish their premises, in some cases after a period where there hasn't been that investment. So as the performance of the business improves, they've looked to reinvest and refurbish their premises across those sectors. In other sectors, Loretta again mentioned the increasing investment into machinery and equipment, and we've seen that come through strongly, some of which is aimed at, I suppose, growing the business, and in some other cases then it's around trying to improve efficiencies in the business to reduce the cost base. Some of that is partly driven by Brexit, but equally others, it's where they're looking at entering new markets and they want to do so from as competitive a position as possible. as I said there, so new market opportunities is some of the reason for investing. A number of companies looking at, I suppose, increasing their IT spend, whether that's, I suppose, for regulatory reasons or from a customer analytics perspective. And a number of technology companies have benefited from that investment. In terms of how they're funding it, I suppose we've seen a mix of companies using their own funds and companies taking on debt to fund that investment. And I suppose there's probably different dynamics at play in relation to both. In relation to the own funds, it probably means that they're investing on an incremental basis rather than in one big bang. Whereas when they're using debt or outside equity to invest, it tends to be, I suppose, a situation where that investment is much more concentrated and they realise the benefits of that quicker, whereas the own funds tends to be over a more protracted period.
It's all about getting the mix right, isn't it? So in particular for small and medium-sized businesses, I see a bit of an over-reliance on their own funds and asking friends and family, what is the right mix? What is the right balance between debt, equity, and own funds?
It depends sometimes in terms of what stage the company is at. So when a company is at a startup or a pre-revenue stage, often that's where the friends and family and the own funds and equity is used to start to fund those initial costs. Then as a company starts to generate revenues and profits, they tend to look more towards bank debt. We recently conducted a survey in conjunction with Red Sea with SMEs. 78% of companies said that they're confident about borrowing, and 23% intend to do so over the next 12 months. And given the position where a lot of companies would have been highly borrowed over recent years, only 10% of companies describe their current borrowing levels as high. So I suppose, look, what that does show is that there's a confidence around taking on debt and there's a capacity around taking on debt. And I think when you're looking at borrowing to fund an investment, there's a couple of things to look at. Firstly, in terms of when you're looking at either purchasing an asset or investing in something that's going to realize benefits over a number of years, to match the term of that investment to the return that you're going to get from it. So if you're investing in an asset that has 5 years or a 5-year lifespan, or investing in a product that has a 5-year lifespan, it's appropriate to fund it over that period of time as well. And in the current low interest rate environment that we have at the moment, often the return on investment can be greater than the cost of borrowing. And as I mentioned earlier on, I suppose using debt to borrow can mean that you can realise the benefits of that investment quicker rather than it being done over an incremental period of time.
Loretta mentioned that both Brexit and infrastructure, lack of infrastructure, housing, broadband are key issues. Let's zoom in on Brexit there for a second. Do you see how small businesses in particular are preparing for Brexit?
Yeah, I think, look, there's a number of areas that companies are looking to try and assess how Brexit will impact on their business and to understand those. And maybe if I just quickly run through some of them. For a number of companies so far, the impact has been in relation to the sterling exchange rate. And as with any risk in a business, it's important that companies manage that risk. And I think we've seen an increasing number of firms look to proactively manage their exchange rate risk. And that has been the impact that a lot of firms have felt to date. As Brexit plays out, I suppose companies do need to understand and plan for how it might impact other areas of their business. So I suppose firstly, in relation to their supply chain or their route to market. So I suppose, how exposed is their supply chain to Brexit? So is there raw materials coming from the UK, or is there route to market either to the UK or via the UK? And not just to consider this in terms of the impact on their own business, but look at their suppliers and look at their customers and try and understand how they might be impacted and work with them in terms of understanding how that could be mitigated. I suppose also then look in terms of how might they be affected from a financial perspective. So if tariffs are going to be part of the end agreement, how is the company going to be impacted from that? Is that something that they can pass on to their customers, or if not, how can they try and improve their competitiveness or their cost base to try and offset the impact of those tariffs? And then also look at the non-tariff barriers. I suppose some companies that trade exclusively with the UK may not have the skills within their own staff, around trying to manage customs and all the regulatory pieces that and documentation requirements that go with that. So to try and develop that skill set among their staff, so that if that does happen, they have the skill set there that they can try and manage the customs checks and the various different requirements that might go with that. I mentioned earlier on, look, that we've seen a number of companies look to try and improve their competitiveness to offset the impact of any tariffs that might come down. And also, as companies look to new markets, they're trying to do it from as strong a position as possible. So I think it's around trying to understand how those areas might impact your business and then how you can plan to mitigate them.
Last question for you, Piers. Coming back to my question in relation to what is the right funding mix. What are you looking for as a bank when you're assessing lending proposals?
We break it into, I suppose, two broad headings. First of all, we look at financial factors, and then we look at non-financial factors. So in relation to the financial factors, I suppose the key thing for us is to understand the financial performance of the business over the last number of years, and really to understand the story behind the financials. So the accounts that a customer provides us will tell us what happened. We want to try and understand the why and the story behind it. So if turnover has grown or margins have reduced, to understand why that happened. And ultimately what we're focused on is what is the cash being generated by the business, and is that a sustainable, is that at a level that can service the level of debt that's being proposed. And in a lot of cases, look, we get projections from companies if they're looking to invest, where that's going to lead to growth in the business. And again, I think it's really around understanding the projections, any changes in terms of from their current performance. So for example, if they're projecting growth, well, what impact might that have on their working capital requirements? So if a shop is looking to expand, does that mean they're going to have to increase the level of stock they have? And if so, how is that going to impact their cash flow? So I think that's just to understand in terms of from a financial perspective. Obviously, from a non-financial perspective, then there are a number of factors as well, where I suppose from the company's point of view and from our point of view, we want to try and understand the market, understand the competitors within that market. And also, as a company grows, it's to understand the skill set of the owner and the management team. So as I suppose, as a company grows, it's important that they look to bring in the right skill set to ensure that they have a broad range of skills within the company that can support that growth. And look, really from our perspective, it's around trying to understand the risks to the business and what are the mitigants to those risks. And I suppose so it's a combination of those financial and non-financial factors that we look at.
This brings our webinar this morning to a conclusion. I'd like to thank our speakers, Dr. Loretta O'Sullivan and Piers Butler. Our next webinars in cooperation with Bank of Ireland will be held on 13th of November on the manufacturing sector and on the 11th of December on the retail sector. Thank you all for taking part in this webinar, and have a successful day.